Most people believe retiring early requires something extraordinary. Millions in the bank, rich parents, a once-in-a-lifetime investment you somehow timed perfectly, or owning a whole portfolio of rental properties. That's the image we're constantly shown. Social media is full of people talking about owning 10 houses, flipping properties every year, or turning a small investment into millions overnight. It makes financial freedom feel like something reserved for people who already have money. But what if the path to early retirement didn't require 10 properties? What if it started with just one house? Not a mansion, not a luxury penthouse, not some massive real estate empire. Just one carefully chosen home, used in a way most homeowners never even think about. And the surprising truth is that this simple approach has quietly created financial independence for countless ordinary people. While most people are busy arguing about crypto, day trading stocks, or chasing side hustles that promise fast money, there's a boring little strategy that has built more wealth for regular people than almost anything else. And because it's boring, most people ignore it. We often assume complicated strategies are more powerful, but that's rarely true when it comes to building long-term wealth. Sometimes the simplest strategy wins. Picture this. You're 28 years old. You've been working for a few years, saving some money, and thinking about buying your first home. Instead of stretching your budget to buy the biggest house you can qualify for, you choose something practical, a solid home in a middle-class neighborhood. Not the trendiest location in the city, but a place where people want to live. Close to jobs, schools, grocery stores, and transportation. The kind of neighborhood where young professionals and families are constantly moving in. Let's say the house costs around $400,000. You put down 20%, get a mortgage, and move in. At this point, it doesn't feel like a financial strategy. It just feels like a normal life decision. You're buying a place to live. But behind the scenes, something important has started. Every single month, when you make that mortgage payment, a portion of that payment goes toward reducing the loan balance. That means you're slowly increasing your ownership of the property. At the same time, something else is happening. The neighborhood continues to grow. Maybe a new hospital opens nearby. A tech company builds offices in the area. A new train line improves commuting. Restaurants and cafes start appearing. Slowly, the value of homes in that area begins to rise. This is called appreciation. And appreciation doesn't have to be dramatic to be powerful. Even a modest 4% annual increase in property value can create huge changes over time. Fast forward 10 years. You're now 38 years old. The house you bought for $400,000 might now be worth around $600,000, depending on the market. Meanwhile, you've been paying your mortgage every month, which means the loan balance has dropped significantly. Maybe you now owe about $270,000 on the house. That means the difference between what the house is worth and what you owe is now over $300,000. That difference is called equity. And this is where most people make a critical mistake. They treat equity like a trophy. They look at their home value online and proudly say, "My house is worth so much now." But they never actually use that equity for anything. It just sits there. Imagine if you had $300,000 locked inside a safe in your attic and you refused to ever open it. That's essentially what many homeowners are doing. They spend decades building equity but never allow it to work for them. Wealthy people think differently. They don't let assets sit idle. They make them produce. Let's go back to our example. After 10 or 12 years, you realize you've built substantial equity in your home. Instead of letting it sit there doing nothing, you decide to access part of it responsibly. You refinance or open a home equity line of credit. But here's the key difference. You don't use that money to buy a luxury car. You don't spend it on expensive vacations. You don't renovate the kitchen just for aesthetics. You use it to invest in income-producing assets. Maybe you invest in dividend-paying stocks that generate regular income. Maybe you purchase a small rental property. Maybe you start a business that produces cash flow. Suddenly, something powerful happens. The house you bought years ago is no longer just a place you live. It has become the engine that funds other income streams. And as those income streams grow, they begin to change your financial life. Let's say you invest $200,000 from your equity into assets producing around 7% annually. That could generate about $14,000 per year in passive income. That's over $1,100 per month. And remember, that money came from equity that was previously doing absolutely nothing. Now imagine repeating that process carefully over time. As the property continues appreciating and the mortgage continues shrinking, your equity grows again. A few years later, you might access another portion responsibly and invest again. Each time you do this, your passive income grows. At first, it might cover small expenses, maybe groceries, maybe utilities, maybe your car payment. But eventually something incredible happens. Your passive income begins covering major living costs. Your rent or mortgage, insurance, food, travel. And once the income from your investments exceeds your monthly expenses, you reach a point called financial independence. It doesn't mean you're incredibly rich. It means something far more powerful. You no longer depend entirely on a paycheck to survive. Work becomes optional. You can still choose to work, of course. Many people do. But the pressure disappears. And this shift changes everything psychologically. When you know you're not trapped by a paycheck, you make different decisions. You negotiate better salaries because you're not desperate. You take career risks that could lead to better opportunities. You start businesses or pursue creative projects. You live with freedom instead of fear. Now here's something many people misunderstand about real estate. They assume you must own dozens of properties to reach this level of financial freedom. But managing many properties can easily become a full-time job. 10 tenants calling you about broken plumbing, repairs, late rent, and maintenance issues can turn real estate into a stressful second career. That's why this strategy focuses on something simpler. One well-chosen property. When you manage a single property carefully, the workload is manageable. It's not overwhelming. It doesn't consume your life. Instead, it quietly builds wealth in the background. Let me tell you a quick story. A friend of mine bought a house in his early 30s. It wasn't glamorous. In fact, many people told him the location was boring. But it was close to a growing medical district. Over the years, doctors, nurses, and hospital staff kept moving into that area. Demand for housing steadily increased. 10 years later, property prices in that neighborhood had nearly doubled. Meanwhile, his mortgage balance had dropped significantly. When he finally looked at the numbers, he realized he had built several $100,000 in equity without really thinking about it. He refinanced part of that equity and invested it into dividend funds. Within a few years, those investments were generating enough income to cover most of his monthly living expenses. Nothing dramatic happened. No lottery win, no viral startup, no once-in-a-lifetime investment. Just one smart property purchase and patience. And patience is the ingredient many people underestimate. We live in a culture obsessed with speed. Everyone wants results in 6 months. But wealth almost always grows quietly and slowly before it becomes noticeable. Think about planting a tree. The first few years, the tree barely seems to grow. But underground, the roots are expanding and strengthening. Then one day, the tree is suddenly tall and strong. Real estate works the same way. For years, it might feel like nothing exciting is happening. But behind the scenes, appreciation and mortgage paydown are steadily building your equity. Time does most of the heavy lifting. Another advantage of this strategy is that it allows you to live well while building wealth. You're not living like a monk saving every dollar. You're living in a comfortable home that's gradually becoming more valuable. That psychological balance matters. When people try to build wealth through extreme sacrifice, they often burn out. But when your home itself is part of your wealth strategy, it feels natural. You're improving your life today while also building financial security for the future. Of course, real estate isn't completely risk-free. Markets can slow down, interest rates can rise, neighborhoods can change. But owning one carefully chosen property gives you flexibility. If necessary, you can refinance, sell, rent out the property, or adjust your strategy. Someone who owns 10 heavily leveraged properties doesn't always have that flexibility. Another important factor is buying the right property in the first place. The goal isn't to buy the fanciest house you can qualify for. In fact, that's often the worst move. Instead, look for properties in areas with strong rental demand and long-term growth potential. Middle-class neighborhoods are often ideal, places where professionals want to live but may not yet be ready to buy. Look for areas near job centers, transportation hubs, universities, hospitals, or growing industries. These factors increase the probability that property values will rise over time. Also, pay attention to properties with small improvement potential. You don't want a massive renovation project that drains your finances for years, but simple upgrades like improved lighting, fresh paint, landscaping, or better fixtures can increase both value and rental appeal. These small improvements compound over time. Now let's look at a simple long-term example. Imagine buying a house at age 30 for $420,000. You put 20% down and take a mortgage of around $336,000. Over the next decade, the property appreciates at about 4% annually. After 10 years, the home might be worth roughly $620,000. At the same time, your mortgage balance has dropped to about $270,000. That creates around $350,000 in equity. Instead of paying off the house aggressively just to eliminate the mortgage, you strategically access part of that equity, maybe $200,000. You invest that money into assets producing 7% returns. That generates around $14,000 per year in passive income. 5 years later, appreciation and mortgage payments may have increased your equity again. You repeat the process carefully. Each cycle adds more income streams. Over time, that income begins covering a larger portion of your living expenses. Eventually, it surpasses them. That's when you reach the point many people dream about, but rarely plan for: financial independence. Not because you saved millions in a bank account, but because your assets produce enough income to support your lifestyle. And perhaps the most important part of this entire strategy isn't the math. It's the mindset. Most people treat their house as a place to live and nothing more. But wealthy individuals see assets differently. They constantly ask one question: how can this asset work for me? When you start thinking that way, everything changes. Equity becomes opportunity, time becomes an ally, and one ordinary house can quietly become the foundation of extraordinary financial freedom. Because sometimes the smartest path to early retirement doesn't start with a huge investment portfolio. Sometimes it begins with one smart property purchase, made years earlier, patiently growing in the background while everyone else is still searching for the next big thing. I hope you learned something today. This is afixlite, and we'll see you in the next video.